Hey, how's everybody doing today? We're going to talk about risk mitigation and risk management in today's topic, and in that regard, we're going to talk about the stop loss order and the stop limit order. Now, for the most part, these two risk mitigation strategies are very similar. However, there are a few intricate details that differentiate them that I think are important to understand. So what you have to understand with both a stop loss and a stop limit is you are identifying a sell price at which you want an order to be triggered. This is awfully beneficial for people who can't monitor their stocks all the time. So for example, if you were going on vacation for a month or two, you would implement a stop loss or a stop limit order on your stocks so that if they drop to a certain point, you can sell automatically. And this happens, it becomes a fill order through your broker. Now the big difference between a stop loss and a stop limit order is a stop loss is more flexible in that it becomes a market order once the trigger price is reached. So let me give you an example. Let's say you own shares in Elevate Investment Corporation and you bought them a year ago for $50 a share and now the shares are worth $100. You want to mitigate risk, so you implement a stop loss order at, let's say, $80 a share. What this really means is that if the stock price is ever going downwards and it crosses or meets $80 a share, a sell trigger will be made automatically without your discretion. It's been put. But what's interesting about a stop loss order is it becomes a market order. So for example, if a stock is downward spiraling, the stop loss order becomes a market order and it goes down with the stock. It becomes a market order, and whatever is happening in the market in that current condition, the stop loss order follows. So if you wanted to sell at $80 a share, but you couldn't meet enough buyers at $80 a share and the next buyers were at $79 a share based on the bid and ask prices, you would go lower. You could also go higher. The main thing to take away is it becomes a market order. Now the stop limit order is different from the stop loss order in that it doesn't become a market order. Let's say the example is exactly the same and the stop limit is at $80 a share. It will only sell at exactly $80 a share. So if in the market it goes from $79.99 to $80.01, it will not be filled. Now this is both good and bad. It depends on how you interpret it. And these two things only really differentiate in the crazy market conditions, in very volatile moments in the stock market. Because for the most part, it's very easy for a stock to hit the stop loss or the stop limit order at exactly that price. But if there's a lot of volatility in the market, there's no guarantee that it can reach that price. And if it doesn't reach that price in the stop loss order, it becomes a market order, and the stop limit order, it stays rigid at that price. So going back to what I said in that it could be good and bad, let me give you an example. If the stock drops below $80 a share and you don't want it to be sold below $80 a share, it may be good to have a stop limit because it will stay rigid at $80 a share and it won't become a sell. This may be good because you don't want to lose money and you don't want to sell at lower prices other than $80 a share. Maybe your interpretation is that it could bounce back up and therefore it's good that the stop limit is in place. Now, from the other side of the perspective, a stop loss order may be good for the exact same reason, because if a stock is crashing, you need to get out quick and fast. There are no more attractive prospects for this company and you need to get out at whatever price available. Like let's say for example a company is becoming bankrupt. Your stop loss order will follow with the market as it goes downward, taking a nosedive, but your stop limit order stays exactly at that rigid price. So is one better than the other? Not really. It depends on what's going on in the market. It depends on your interpretation with the stock and your vision with the company. So to quickly summarize, both the stop loss and the stop limit are agreements to sell a stock at a predetermined price. Once the market price crosses the stop loss order, it becomes a market fill. However, with a stop limit, it only sells at the exact price. So if it drops lower, it won't be filled. For the most part, most people sell at market conditions. So when you go on, for example, a platform, this is my TV platform. Most of the time, I'm selling at the market because the price difference when you're trying to sell is only a few cents usually. It's not a huge spread, but these are just two different ways you can sell stocks and can be risk mitigation strategies that I want to share with you guys. So thank you so much for listening, guys, and I hope you guys have a nice day. Take care.